Hello everyone and welcome to my channel. Today we will continue talking about revenue recognition. Some of the issues related to revenue recognition are sales returns and allowances, repurchase agreements, bill and hold, principal-agent relationships, consignments, warranties, and non-refundable upfront fees. In this video, we will talk about consignments. I already recorded several videos about accounting for revenue recognition issues. You can find them in the revenue recognition playlist. I'm posting it right here and in the description below. A common principal-agent relationship involves consignments. In cases of consignments, manufacturers or wholesalers deliver goods to resellers but retain title to the goods until they are sold. This specialized method of marketing certain types of products is known as a consignment. Under this arrangement, the consignor, a manufacturer or wholesaler, ships merchandise to the consignee, a dealer or reseller. The consignee accepts the merchandise and agrees to exercise due diligence in caring for and selling it. The consignee remits to the consignor cash received from customers after deducting a sales commission and any chargeable expenses. In consignment sales, the consignor uses the modified version of the point of sale basis of revenue recognition. This means that the consignor recognizes revenue only after receiving notification of the sale. The consignor carries the merchandise as inventory throughout the consignment, separately classified as inventory consignments. Remember that the consignor retains title to the goods until they are sold. The consignee doesn't record the merchandise as an asset on its books. When merchandise is sold, the consignee is liable for the net amount due to the consignor. The consignor periodically received a report called account sales or similar from the consignee. The report shows the merchandise received and sold, expenses charged to the consignment, and the cash remitted. The consignor then recognizes revenue. Under the consignment agreement, the consignor accepts the risk that the merchandise might not sell and can be returned. The advantage to the consignee is that it doesn't need to commit part of its working capital to inventory. Both consignors and consignees postpone revenue recognition until merchandise is sold to a third party. Consignees only recognize commission revenue. Let's look at an example of a consignment sale. Precision Manufacturing Company ships merchandise costing $36,000 on consignment to Central Computer Stores. Precision Manufacturing Company is a consignor, and Central Computer Stores is a consignee in this agreement. Precision pays $3,750 for freight costs. Remember that freight in is the cost of bringing goods into the company. Freight in is a part of the production process and will be capitalized into inventory and expensed through the cost of goods sold when the product is sold. Central Computers pays $2,250 for local advertising costs that are reimbursable from Precision. By the end of the period, Central Computers had sold 2/3 of the consigned merchandise for $40,000 cash. Central Computers notifies Precision of the sales, retains a 10% commission, and remits the cash due to Precision. I will show you how the amount is calculated later in this video. The goal of this exercise is to determine what journal entries the consignor and the consignee make to record this transaction. Let's first summarize the events. First is the shipping of consigned merchandise. Second is the payment of freight costs by the consignor. Third is the payment of advertising by the consignee. Number 4 is sales of consigned merchandise. Fifth is the notification of sales and expenses and the remittance of the amount due. And finally, the adjustment of inventory on consignment for the cost of sales by the consignor. This table compares entries recorded by both parties side by side. The consignor is on the left and the consignee is on the right. We will look at each step in detail, but this is an excellent summary to compare how each party of this agreement records journal entries. 1. Shipping of consigned merchandise. Precision Manufacturing Company ships merchandise costing $36,000 on consignment to central computer stores. The shipment of consigned merchandise is recorded as follows. The consignor debits inventory in the amount of $36,000 and credits finished goods inventory for the same amount. Note that both accounts in the consignor's journal entry are inventory accounts. The consignor still owns inventory, and this entry is only necessary to keep track of inventory on consignment. The entry doesn't affect financial statements. Central Computer Stores, the consignee, makes no entry at this point. 2. Payment of freight costs by the consignor. Precision pays $3,750 in freight costs. The payment of freight costs by the consignor is recorded as follows. The consignor debits inventory and credits cash in the amount of $3,750. Both inventory and cash are asset accounts. Assets are increased by debit and decreased by credit. There is no entry for the consignee. 3. Payment of advertising by consignee. Central Computers pays $2,250 for local advertising costs, reimbursable from Precision. The payment of advertising by the consignee is recorded as follows. There is no entry in consignor's books until notified by the consignee. The consignee debits receivables from consignor and credits cash in the amount of $2,250. Both accounts are asset accounts and are increased by debit and decreased by credit. 4. Sales of consigned merchandise. By the end of the period, Central Computers had sold 2/3 of the consigned merchandise for $40,000 cash. The sale of consigned merchandise is recorded as follows. There is no entry in consignor's books until notified by the consignee. The consignee debits cash and credits payable to consignor in the amount of $40,000. Payable to consignor is a liability account. It is increased by credit and decreased by debit. Note that no revenue is recognized at this point. 5. Notification of sales and expenses and remittance of the amount due. The notification of sales and expenses and remittance of amount due is recorded as follows by the consignor. Remember that Central Computers retains a 10% commission of the sales and remits the cash due Precision and gets reimbursed for advertising expenses. Therefore, Precision needs to record both advertising and commission expenses. This is a compound journal entry, as it has multiple debits. The consignor debits cash in the amount of $33,750, debits advertising expense in the amount of $2,250, debits commission expense in the amount of $4,000, and credits revenue from consignment sales in the amount of $40,000. Expenses are increased by debit and decreased by credit. Revenue is increased by credit and decreased by debit. Watch my video Rules of Debits and Credits for more information and examples. I'm posting the link here and in the description below. Central Computer Stores, the consignee, debits payable to consignor in the amount of $40,000. Credits receivable from consignor in the amount of $2,250. credits commission revenue for $4,000, and credits cash in the amount of $33,750. Remember that the consignee remits to the consignor cash received from customers after deducting its sales commission and any chargeable expenses. 6. Adjustment of inventory on consignment for cost of sales. Since merchandise was sold, the consignor must record the cost of sales or cost of goods sold. The adjustment of inventory on consignment for the cost of sales is recorded by the consignor as follows. The consignor debits cost of goods sold and credits inventory consignments in the amount of $26,500. The amount of COGS is calculated as 2/3 of $36,000, the cost of merchandise, plus $3,750 freight-in expense. There is no entry to central computer stores, the consignee. I hope you found this video helpful. If you did, please make sure to subscribe, hit the like button and ring the notification bell so you are notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.